So you've got a business, but what about a brand? The difference? More of you. Wix gives you the freedom to create your website, own your brand, and do it on your own, exactly how you envisioned it. Experience limitless customization. Boost your creativity and efficiency with AI tools for every part of your business journey. Scale up with built-in SEO, e-com, and scheduling features. Put more of you in your business. Go to Wix.com and do it all yourself.
This is Scott Becker with the Becker Private Equity and Business Podcast. Thrilled today to visit with Rick Kes of RSM. RSM's the leader in sort of the middle market private equity consulting world, has built an incredible franchise in terms of quality of earnings, valuations, all kinds of work advising buyers and sellers in the private equity world. Rick, one of the things that's fascinating, and I know you can't comment specifically on companies, so I'll mention a couple companies, but we'll just use it as a tee-off point for the discussion. Both KKR and Carlyle Group recently disclosed last quarter earnings, and what you're seeing in the private equity world is something that's fascinating. You're seeing the big fund companies with higher and higher fees, but not enough profit from exits and delayed exits. So you're seeing sort of their stock price both took a little bit of a dive based on their results, even though they were great results, but they were driven by fees and lending and other kinds of fees from lending versus actual exits. Similarly, KKR reported this weekend that they're making additional strategic investments in their strategic holdings category, which is long-term buy and hold versus traditional buy, build, and sell. What is your sense of what's going on in the private equity world, and how much of a challenge is it that people are having trouble getting to the exit line on the last vintage of funds? I guess that's a long intro to the question of what do you see on these delayed exits and what should we expect?
Yeah, Scott, I think it's a fascinating question, and obviously one that we have a lot of discussions with our private equity group clients about. And I think if you kind of peel back some of the pieces of the onion, if you think about timing, if investments were made in 2016, 2015, 2013, 2014, sometime in that period, and then you put yourself like 5, 6, 7 years into hold period, you run into COVID. COVID obviously disrupts the entire economy and has long-term impacts. 3, 4, 5 years out, we're still seeing impacts related to COVID, especially to deal prices. So, I mean, some of the exits that have happened perhaps didn't happen at the price that the buyer was initially hoping for. They had to make a deal because of whatever reason that might have been out there for them. And then, the growth of the company and some of the other things related to that company might have been different than what they would have expected pre-COVID. And so I think that, if you think about what COVID did to the private equity period, a hold period, I think you're seeing that come through in some of these other things that are being announced in the world related to a longer hold period, maybe some of the sale prices not being where they would have hoped for or expected. And, perhaps an appetite for a longer period of a hold period because, maybe they're able to kind of fix some of the things that happened during, the COVID shock and then really be able to kind of grow from there and then amplify growth in the future. So I think if you take it back from at least my perspective, a lot of this has to do with kind of the economic shock that COVID brought us to the entire economy.
And fascinating. And what's your sense of the interest environment? People thought it would start to cooperate again, but it doesn't seem like it's going to cooperate again too much in the near future just because inflation is still there and hard to cut rates with relatively full employment and inflation. So I mean, that's what people are really expecting a huge run-up in activity and a 50 to 100 point reduction in interest rates this year, but that seems to be slowing some, at least the interest rates.
Yeah, I do think that's true. I think with inflation and like you mentioned, the job environment kind of being where it's at, if we're at a full employment, world and inflation still kind of is at a clip above where the Fed wants it to be, they don't have a lot of other levers to pull. To reduce interest rates would just create more inflation in theory. And so I think we'll continue to monitor it, but I think at some level too, we have to balance that between the fact that we have full employment is also great for the consumer, right? And I think if you think about our economy being heavily driven by consumer discretionary spending, that's a big part of why we should continue to think about how do we capitalize on that piece of it and really try to, maybe manage what we can as business owners or private equity fund managers or whoever we are in the ecosystem, and try to figure out, well, the interest rate environment is sort of out of my control. But one thing that is in my control is finding the consumers and taking more of the market share from them because they have cash, they're employed, they're out there working. Let's find a way to get them to spend money in our business as opposed to somebody else's business.
No, I think that's true. And one of the challenges, of course, is as you if in fact you cut deficit spending at all and you keep interest rates still a little bit high, you're going to end up in a spot where exactly what you're talking about, for a period of time, it feels like it will be a bit more of a zero-sum game versus the expansive growth you had with low interest rates and insane deficit spending. Not that it's not good to get the deficit under control, but it does mean that some of the artificial growth and artificial opportunities will not be there.
Yeah, I think that's spot on, Scott. I think it just brings you back to really, what we were talking about maybe even a year ago or even before that, before any interest rate cuts. The interest rate environment is a little bit out of your hands. You can find value in other places to really drive EBITDA growth and attraction. Because I think what I keep hearing from private equity firms is that A, assets still trade. B, assets may or may not trade. C, assets and below, it becomes very, very difficult to trade those assets. So I think you really need to focus on making your business as close to or an A asset as possible so that you can, find value. And by doing that, I mean, finding opportunities to become more efficient, finding opportunities to, really, advance your leadership team within that company and really finding ways to drive value beyond maybe what the interest rate environment may create for you. You got to figure out what you can actually control, and that's typically, finding opportunities to bring value to those businesses that you own and be able to make them attractive to buyers regardless of the interest rate environment that you might be in.
No, I think that sounds right on. I mean, it's back to sort of fundamentals of business and creating a great business without a lot of fluff and ability to just make money just because there's big tailwinds with you. You better be doing a great job with your management team, your operations, your business, your execution, everything else. Rick, I want to thank you as always for joining us on the Becker Private Equity Business Podcast. I always learn something, and thank you so much for joining us. Just fantastic.
Thank you, Scott.
You know where your business would be without you. Imagine where it could go with more of you. Well, with Wix, you can create a website with more of your vision, your voice, your expertise. Wix gives you the freedom to truly own your brand and do it on your own. With full customization and advanced AI tools that help turn your ideas into reality. Scale up without being held back by cookie-cutter solutions and grow your business into your online brand. Because without you, your business is just business as usual. Take control. Go to Wix.com.